Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Mike Wilson of Morgan Stanley joins us ahead of the most important earnings print in years. I'm not sure, Mike, if you'd agree with that. I will ask you this, though. What is more important, Mike, for you? This address from Chairman Powell a little bit later this morning, or that payrolls print on September 6th?
Yeah, good morning, John. I think, in my mind, it's about the payroll number. It's really about the labor data, period. That's what's going to dictate what the Fed does. They've said that, and that's what the market's going to trade off of. I mean, if you go back a month ago, that's when we had this correction, and it really did kick off with a weaker non-farm payroll number. Now that has been somewhat refuted by better claims, and also just the deal that jobs are okay still. But then we got the revision, so the data is still very mixed in my view, and the market under the surface, as we like to look at it, is still trading very defensively. It doesn't know. So I think it comes down to that payroll number. The Fed will react, and we'll see. And we'll see how the market goes. I mean, my general view is if they cut 25, that's probably fine. If they cut 50, historically, that has been a bad signal for the equity markets.
Mike, you say the market's traded pretty defensively. I want to pick up on that and just build on it a little bit. In some places, we've started to see that breadth improve again. Small caps have started to perform. We've seen the record highs on the equal weight through this week so far. Mike, do you think we're just as vulnerable as we were at the start of the month to weak data, or have we reset things differently this time around?
I think we're more vulnerable to another negative data point on the labor market. That was sort of a warning sign. And once again, we don't know the result, but if we get a negative payroll number, I think the market could react just as bad at the index level. So let's talk about that under the surface. I mean, you mentioned small caps have done better. Well, they did better in July when the money rotated away from the Magnificent Seven and some of the quality growth leaders, and it went into defensives, quite frankly. So defensives have now, and when I say defensives, I mean utilities, healthcare, staples, and real estate. Those four sectors have led on a 5-day basis, on a 1-month basis, and a 3-month basis. So it's been very consistent. And that's about the time we pivoted back in May to a more defensive book. And I don't really see any reason to kind of deviate from that. Now, if we get a very strong payroll number, then that trade is going to reverse sharply back to the more cyclical parts of the market. I think it's going to be very messy. I don't anticipate the labor data to improve dramatically. I don't know if it's going to deteriorate further. But given the signal from the stock market and the bond market, quite frankly, the markets are definitely paying attention to this, and this is a big number.
Mike, if I can ask, what probability of a recession do you think the equity market's essentially pricing in? And you can look at breadth there, or you can look at aggregate. And the other question was on margins. How do you see that evolving? Because I felt margins had a nice tailwind with the fact that essentially cost of input prices were coming down. Does that change? If prices are going to be more stable, it's all going to come down to those sales numbers. So I guess 2 questions.
Yeah, we'll start with the second one. I mean, I think you're dead right on. I mean, what the micro data has been definitely weaker than the macro data. And let me just take a minute on this. This kind of goes to my core thesis that we basically have a policy mix, call it fiscal dominance, where fiscal policy has been really the dominant lever for the last couple of years. That's what led to the inflation breakout, in my view. There were some supply constraints, sure, but basically we had too much aggregate demand from fiscal stimulus. And now that has somewhat prevented the Fed from being more proactive with rate policy. And in effect, it's crowded out, as you were mentioning earlier, it's crowded out the middle class, it's crowded out the lower class, lower income class for sure. And even some of the wealthier investors now are being crowded out. And that's why small caps have underperformed so much. So that's very much intact. And I think that that policy mix has been unusual. It has also extended, I think, the cycle longer than what it probably would have been, which has kept the Fed doing their job of keeping rates higher for longer. And now it's working. Now it's really starting to bite in the interest rate sensitive parts of the market, like housing, autos, and some of those areas. So overall, I would say that at the S&P level, it's not really pricing in a recession at all. I would say at the stock level, it's probably similar to where the bond market is. That's why we have defensive leadership. That's why small caps have been persistently underperforming. And it's probably in the 20% range or so. And that's what always happens, right? Until it's definitive, the stock market doesn't really want to go there, and it won't go there because it needs the hard data.
Thank you, which actually makes a lot of sense to me. We all see the same data. So this idea that the bond market might be pricing is something very different from the equity market. I mean, we're all looking at the data. We're all listening to the Fed. One point you made earlier that 50 basis points might be viewed negatively. And I see the point. What does the Fed know that we don't know? Why are they cutting 50? But if we hear from Chair Powell, and I don't know if we'll hear it today, but providing a context around potentially going faster initially, that if monetary policy is restrictive, they're just trying to reduce the level of restrictiveness. You think the equity market might like it, that they can be a little more aggressive initially so they're not behind the curve? I guess that was a learning from the hiking cycle. It would be to start earlier so you don't have to do as much. You think he can finesse that message and keep it in the normalization of 50 basis point cut?
Well, anything's possible for sure. I'm just saying, historically speaking, when the Fed is kicked off with a 50 basis point cut, it usually has led to, not a great outcome. That basically we're on the downswing on the cycle. Now, this cycle's been unique. They probably got higher than they initially planned. So maybe that sort of situation doesn't apply this time. So I'm open-minded to anything. All I'm saying is that if the Fed were to do 50, that means the data probably deteriorated more. Okay, that's really kind of where that comes from. And that would suggest that probably the labor market in particular deteriorated more. And that's how the bond market's pricing it right now, right? I mean, they're basically saying a 25% chance of a 50 basis point cut. That's not, that's much less than it was 2 weeks ago.
Mike, let's squeeze in some sector preferences as well. I know you're not a big fan of consumer discretionary based on the conversation we've just had. Industrials, how do they fit in? Why do you like that part of the market so much right now?
Well, I would say, we don't love industrials here. We're just saying in the in the cyclical bucket, you got to own something, right? You can't just be totally naked on cyclical exposure. And if there is one group that we would gravitate towards, it would be the industrial sector, that cyclical preference is there. Within technology, which is a cyclical group, I would say we would skew more towards software rather than semiconductors or hardware, simply because they're more defensive, but it is cyclical still. So those would be the two cyclical groups that we would like in conjunction with our defensive bias, which is utilities, healthcare, staples, and real estate.
Mike Wilson of Morgan Stanley. Mike, always great to catch up with you, sir. So here's the latest this morning. Kamala Harris formally accepting the Democratic nomination, prioritizing a fight for America's middle class. Donald Trump zeroing in on immigration as his counter-programming campaign made a stop at the US-Mexico border, threatening large tariffs on countries that don't accept deported migrants. Joining us from the DNC in Chicago is Bloomberg's Anne-Marie. AMH, let's get straight to it. The question that came from the former president, why didn't she do these things that she's complaining about? What's the response from the Democratic Party to that?
Well, Jonathan, she gave this speech last night, which I think you nailed it. It was heavy on vibes and rhetoric and short on policy. That is normal for acceptance speeches. What Donald Trump is going to do now, and when we're on a race 74 days to this election, he is going to want to define her and tether her to Biden. Biden obviously was not polling well, not only because of things like inflation and his age, but also just, other things not happening under the surface, broader in the economy as well as immigration. So Donald Trump and his campaign has been trying to nail Kamala Harris on those specific policies. Yesterday was really her introducing herself to the American people at the top of the ticket, not just as the VP slot. And when you look at some of the broad parts of policy, whether it's the economy, foreign policy, immigration, and reproductive rights, it really felt like a continuation, or at least she was cherry-picking parts of the Biden menu that she would carry through to her administration. Not a lot of details, but broadly in line with what we've been seeing from President Joe Biden. Maybe she spent a little bit more time on reproductive rights, something that she really talked about when she was vice president already and Joe Biden stayed away from. But mostly this felt like a continuation. And Donald Trump is going to try to really tether her to Joe Biden because he polls well when it comes to things like the economy and immigration, and Joe Biden and Kamala Harris did not.
When it comes to Donald Trump, can we talk about one specific policy that's been mentioned in the last 24 hours, threatening large tariffs on countries that don't accept deported migrants? What's been the reaction to that?
Well, Jonathan, when it comes to the Democratic reaction to migration, immigration, Kamala Harris said yesterday this would be her policy position, which is to bring back the bipartisan immigration agreement that was struck between a number of senators, most notably Senator James Lankford of Oklahoma and Connecticut Senator Chris Murphy, and that Democrats have been hammering that the reason why that deal did not go through because President said, I want that deal killed because I want the issue. So that is their current plan, which is more support for border security, the ability for the president to have his executive power to shut it down. When it comes to tariffs broadly, at the entire DNC, they have been talking about the fact that this is a sales tax. They don't want to say the word tariffs because remember, Jonathan, this administration also kept tariffs from the Trump era under Joe Biden's watch, some of those Chinese tariffs, but they are calling it a sales tax.
MH, appreciate the input. We'll catch up with you in about an hour's time from the DNC in Chicago. Speaking of the menu, BTIG's Isaac Boltansky with this to say. The Harris campaign has treated Bidenomics like a buffet, whereby they can embrace the issues that play well at the kitchen table while hopefully leaving the less politically palatable provisions behind. Isaac joins us now for more. So Isaac, let's build on that. What's on the menu?
Well, sure. Thus far, it's whatever plays well with the vibes, as you said, right? Like all that we've learned over the past few days is that they have a triangulation play called here to do their best to A, blunt the attacks that Vice President Harris is too liberal, and B, to meaningfully separate Vice President Harris from some of the more contentious Biden issues and to portray her as a change agent. And that's why you saw President Trump just last night trying to tag her as the incumbent. And that's what the next 74 days is going to be about. Is Vice President Harris seen as a representation of the current administration and the incumbency, or is she seen as an agent of change?
Isaac, when you sit down with clients, when you catch up with them in person and over the phone, and they ask you, Isaac, which candidate is the pro-market candidate? Have you formed strong ideas about that yet?
You know, look, I think what we tried to focus on is acute market themes, right? Like we feel pretty strongly that Trump is good for M&A because he's going to change the leadership at the FTC, right? That's something that we can really sink our teeth into. When clients ask who's good for the market broadly, I think that one's a lot tougher because when you look at Trump's policies, we're talking about tariffs. Right? We're talking about uncertainty in the global economic regime that I don't think folks are really getting their arms around, especially since we're not going to have the sugar high of tax cuts that come along with that. And so I think that that's really the distinction that we've made. And the point I've tried to make to clients, and the one that I think we really need to start understanding and sinking our teeth into, is no matter who is in the White House, we're going to have buckets and buckets of deficit spending coming through the tax reform effort that comes next year.
Hey, Isaac, in terms of more detail on Harris's policies, do you think that's a when or an if? Do you think she's going to try to go as long as possible without providing detail on that, or is she being sort of strategic about it?
I've been surprised at how open Democrats at the convention have been in their belief and their hope that she will not offer much policy detail. I found it interesting that a number of top Democrats have said, do you remember that Elizabeth Warren, when she ran in 2020, had a white paper for every policy? There were 20 pages, well vetted by academics and market experts for each policy, and she sure as heck didn't win, so why would Harris? And so, look, I think that this is, again, going to be something that they ride the vibes, which John has outlined, for as long as they possibly can. The date that I have circled on my calendar is September 10th. That's the first and only debate between these two. And to me, that's the moment where perhaps the rubber can meet the road in terms of some of these policy specifics that I think we're all yearning for.
Isaac, we couldn't agree more. What is particularly striking to me as well is how much room, how much space progressive like Warren, Alexandria Ocasio-Cortez have given the Vice President Kamala Harris, they're not tying her to unpopular themes. If you think about where Harris was back in 2019 going into 2020, if you were running in that primary, you had to make commitments to things that weren't going to be popular with the rest of the country. Do they continue to give her that kind of space, Isaac?
I think they do until Election Day. And so there are 2 points to make here. Number one is the one unifying issue for Democrats is that they are against Trump. So as long as they can keep this race about Trump, they will remain together. But the second point, and the one that I think that we should examine over time is, I truly think that if Democrats are in power, you're going to start to see those fissures reemerge. And AMH mentioned the immigration bill that failed. That immigration bill had a chance to become law this year, in large part because of the election. Now, if Democrats win the White House and they're in power in Congress in some way, shape, or form, I'm not sure that same immigration bill passes, because at that point, you see the progressive voices rise and become even louder. And so that's something when we think about that chasm between rhetoric and reality that warrants consideration.
Isaac, when it comes to blue sweep, red sweep, formed any firm ideas on that one also? What's your base case now?
Look, at the moment, I think that we're going through the presidential election. They're the seven on the presidential side. They're the 7 states that matter. I still think that you have to look at the issues that animate those voters. The top ones are the economy and immigration. Trump does better on average by 8 and 15 points in the swing states. As long as that maintains, I view Trump as a slight favorite. On the Senate side, I remain committed to our view, 80+% likelihood that the Senate is going to flip to Republican control. And I think that's something that investors and markets should really moor themselves to, is that we will have a small Republican margin in the Senate that can then give us some sort of framework for thinking about what next year will look like.
Interesting. Isaac, thank you, sir. Appreciate the update. Isaac Boltansky there of BTIG. We begin with our top story. Stocks rising as traders await Fed Chair Jay Powell's remarks at 10 a.m. Eastern Time. Bob Dole of Crossmark writing the following: the global economic expansion remains intact and will benefit from rate cutting expectations. Equity valuation remains at risk, especially if growth continues to decelerate and the Fed does not show urgency. Bob joins us now for more. Bob, I want to talk about a gap, a spread, if you will, the difference between Fed funds and the 2-year. You've noted that's the widest going all the way back to 2008. And when people say 2008, Bob, they get worried, concerned. How worried and concerned should they be?
Well, the jury is out. The economy is slowing. I don't think people can dispute that anymore. But we don't know, is it going to be a soft landing or a harder landing? And look, that's, in my view, out of the Fed's control. The Fed, what he does in the next few meetings will impact the economy later. So it's already cooked and we just don't know. So if you want to be fearful, pretend there's going to be a hard landing. Not out of the question. The consumer's slowing. You're seeing it all over the place, but we just don't know how slow they're going to get. That's the problem.
Well, play best guess with me now. Let's take that spread. You've got Fed funds up here and the 2-year down here. How do you expect that to close? Is it the 2-year yield coming up to Fed funds coming down, the two meeting each other? What's that going to look like?
Look, the Fed's going to lower rates. The chairman will make that clear today. But as you and Stuart talked about earlier, we just don't know the pace of that decline. You recollected appropriately, January 1st, we're going to get 6 cuts this year. Oh, no, it's going to be 7. Well, here we are, and we haven't seen one yet. And so I think it'll be slow but deliberate, and the language will be, we'll watch very carefully. Look, inflation, remember, is still 2.8. It's not 2. So they have to have their one eye on that corner of the world, too, as they, on the other hand, begin to fight this emerging economic slowdown.
Bob, we've rallied into this story. We've noted that the equal weight S&P 500 has printed a couple of all-time highs so far this week. We've seen the leadership come from the small caps at times once again. With that in mind, are we more at risk of this data coming in weaker all over again on September 6th?
I absolutely agree. That's the question mark, and that is the risk. that things slow down faster than the market is expecting. And there's a little bit of, whatever ails us, the Fed will have the cutting power to fight that. Well, what the Fed does today doesn't affect the economy for some time. A little psychology maybe, but that's about it. So it is, how fast does this thing slow?
And Bob, along those lines, how sensitive do you think the Fed is to financial conditions here? How reactive would they be if we got, a sharp pullback in equities on some weak labor market data, in your view?
I think you bring up a good point, and that is things that might be out of our control. Look, we had that a month ago. It turned out to be, the Japanese yen carry trade. And, as the market was falling those 3 days, we just had some clues. It was, it's a fear about the economy falling apart that's causing this decline. Well, maybe that's what started it, but we know what aggravated it. So to your point, the financial system doesn't necessarily operate smoothly every day, and we could get a bump there as well. Not predicting that, but there is always discontinuity in the system.
And you mentioned high valuation. Would you have the view that the market kind of needs some rate cuts given the level of valuation here, or do you think we can kind of skirt through things if growth stays okay?
I love the way you put it. Valuation is demanding a good environment, maybe a perfect environment. And therefore, the Fed better do exactly what they need to do, and earnings better come along, and we better not have any more consumer weakness. A lot of good news in this market with the PE into the 20s. So yes, we do need to justify these valuations, reasonably good economic news and/or Fed assistance.
What would you advocate for going deeper into the second half then, Bob? I'm just sitting here guessing that you're not telling everyone to sit in cash and take 5% and wait it out. What are you telling them to do?
Exactly. On the other hand, we've got this momentum-driven bull market, and fighting that kind of market is a fool's game. So you got to be invested. Just be careful what you own. You've heard me say it before: earnings predictability, earnings persistence, and cash flow. So should we get into sort of a bumpy environment, those kinds of stocks will sell off less, but they'll do just fine on the upside.
And Bob, a lot of those stocks you described, I think, are what people have kind of owned, for a period of time here. Is that a steady as she goes, or would you worry about positioning, being so long of those kind of stocks if we did come under some pressure? This is a debate we feel like we're having on tech all the time. Are they safe or not, basically?
Yeah. So I would broaden the list. Valuations got to come into the question relative to the earnings persistence, et cetera, list that I put together there. I wouldn't just own high PE stocks. They have some vulnerability should things not go all that well. And back to what Jonathan said a few minutes ago, the market is broadening. And to those of us who are a little cautious, that's a good sign that we're getting some broadening. I guess it couldn't get much narrower.
Yeah, I think that's the question we get on the broadening theme is, am I willing to broaden out into a weakening economy? And I feel like that's like a big trade-off that people are struggling with. Do you have a view there?
Yes, I do, and that is be careful how much broadening you do. We all know that down cap, small in particular, tends not to do well in economic slowdown environment. They do best when we come out of a recession. And so I think don't be zero in those areas, as many people are, but don't overdo it. We've lost 2/3 of the small cap rally we saw in July relative to big cap. That's a lot of deterioration, despite the broadening that we're speaking about here together.
Another way of asking the same question: do I want to own financials going into the back end of this year, Bob? Yes or no?
Yes, absolutely. I think look, a lot of lending took place outside the banking system. That's why bank balance sheets are on average, better shape today than they are typically at this point in the economic cycle, and they're pretty cheap. So, yes, I would own financials.
Big bounce off the low from earlier this month. Bob Dole at Crossmark. Bob Dole, thank you.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.